So I was preparing a presentation for a bunch of small business loan officers and created a bunch of slides about Goodwill. And I realized, hey, I haven't talked about Goodwill on the YouTube channel in quite some time. So today we're going to talk about Goodwill in small businesses.
I'm David C. Barnett, and you're tuned in to Small Business and Deal Making, the podcast, YouTube channel, and blog where I talk about buying, selling, financing, and managing small and medium sized businesses while controlling risk. So, if you're looking to take control of your future through buying a business one day, or if you already own a business and you're looking to grow or exit, you've come to the right place. I talk about interesting things, I talk to interesting people, and I answer your questions every week right here. So, be sure to hit like and be sure to hit subscribe, and let's get to it. Are you thinking of growing your business or beginning a journey into entrepreneurship? Take a shortcut to success by buying an existing and profitable business the right way. Visit businessbuyeradvantage.com and learn more about my online training, group coaching, and consulting services designed to help you win.
All right. So the term Goodwill appears a lot when people are talking about small businesses, especially sellers who believe that this is an ingredient that gives their business increased value, right? And so I think that the very first thing we're going to talk about is the definition of goodwill. So I've got this image, and this is from the slide deck I was preparing for those lenders. Um, and so you can see right here, uh, what is goodwill? Number one, it's an accounting definition, which is simply the difference between the value of the business and the value of the tangible stuff within it. Okay. So a business, which is nice and profitable, could have an agreed upon selling price that is a higher price than the value of the things in the business. And as a business owner, this would mean that you have managed the business to such because you're creating this additional value, not from extra things in the business, but just from the way that you are operating the business, right? Definition number two, I call it a colloquial definition, just the way people throw this word around all the time. And I put here for this definition the positive intent in the marketplace towards a business or its owner's reputation. So you could say that the doctor's practice has a great deal of goodwill because of the positive reputation, right? But the doctor's practice is not a very sophisticated business, and really the earnings are limited to the amount of time that the doctor spends with patients. And at the end of the day, the doctor's earning basically an amount of money through their practice, which would be equal to the fair market wage they could command in the marketplace. And so there really isn't any goodwill in that business because there isn't any surplus earnings over and above the value of the doctor's own labor, right? So so that colloquial definition, though, is one that people use in everyday conversation, where they'll talk about the level of respect or whatever that people have for a given business. And the third box there on the screen says if the second item here is truly valuable, so if the reputation and renown of the business is in fact as great as people believe, then it should allow for greater profitability, which would then enhance the first definition, which would be the accounting definition. So we would end up with a cash flow a cash flow whose value is greater than the sum of the tangible assets put together. Now, now, why am I putting this up here? Because very often when I talk to people in the world of business, they will believe that goodwill is somehow attached to the value of the stuff. So you'll have a business perhaps that maybe isn't that great at all, but it owns a lot of stuff, equipment, machinery, etc. And so somebody will then believe that their business's value is the value of the stuff, and then they need to create some kind of abstract reason for goodwill, quote unquote, that there needs to be an additional payment over and above the value of the stuff. I see this quite often where you'll have like, for example, a foundation company that'll own $1 million worth of equipment, and that foundation company is producing a cash flow of maybe $250,000 a year for its owner. And so anyone who is buying the cash flow might agree to pay 500 to 750,000 for that cash flow, but the stuff is worth more, right? You see what I'm going here? So the seller of that business, though, they don't like to hear that what they've done is they've accumulated assets and now they're operating them at a less than ideal kind of way that actually requires that the business be sold at a discount to its asset value in order to be sold because they're not producing enough cash flow from the assets. And these are tough situations where oftentimes, if I'm dealing with a seller like this, we'll go through and look at the different assets and figure out what assets we might be able to remove from the business and still have it function in the same way. So, really, the seller then is able to realize value through the liquidation of some of those things without reducing at all the cash flow value of the business. Often, though, what'll happen is that a person who owns such a business like this will say, "My business is worth $1 million because my stuff is worth 1 million, and then I want another 200 grand for Goodwill." And they'll just believe the fact that they've been active in the marketplace and that there are people out there who know their phone number somehow entitles them to this extra amount of money, even though that they haven't been able to execute the business in a fashion that would indeed deliver this value. Now, this gets us to another point, which is, when do you see goodwill actually written on a set of financial statements? Okay. So let's take a quick look here at a simple example. So this is in Excel, and I'll describe it for the people here who just listen to the podcast. So we're going to say that there's a business with a cash flow of $200,000 and it requires no accounts receivable. So it's a very simple kind of business where the customers pay in cash, upon delivery of the service, and that the business has a very simple balance sheet. There's $150,000 worth of machinery in this business, and there's $50,000 worth of inventory. And if you add those two numbers together, you get $200,000. So if you were going to buy this business, we've just said that you agree to buy it for 500,000 based on the cash flow, but the stuff in the business is worth far less than the $500,000. What would it look like for you if you were going to buy this business? You would have to then, we're going to assume an asset sale. So you're creating a new entity to acquire these things from the entity of the seller. And what would your balance sheet look like after doing this deal? Well, I've got an example here of an opening balance sheet for your new business. And as you can see, because you have paid them 500,000, you have acquired things worth 500,000. You need to actually have $500,000 worth of stuff in the asset section of your balance sheet. So you can see what I've done here is I've got machinery for 150, inventory of 50, and then it says goodwill 300,000 for total assets of 500,000. And then in the liability section here, I just assumed that you borrowed 80% of this money. So I have a loan there for 400,000 and your own equity of 100. And that then adds up to 500,000. So the balance sheet balances. And so this would be an example of where you would actually see goodwill on a balance sheet after doing a transaction. And what the only way that goodwill can ever appear on a balance sheet is through a transaction like the one I've just described. So if you're looking at a business that may be for sale, for example, and you see goodwill listed on their balance sheet, what it means is that that company you're looking at has at one point in its past done an acquisition, and there was some kind of surplus payment in excess of the value of the tangibles in that deal, and that's how they ended up with goodwill on their balance sheet. Now, um, let's talk about where the goodwill resides, because this is also another kind of feature of this whole conversation, and it's important for people that might be wanting to acquire a business. Because in the example I gave, we agreed to pay $500,000 for that business that only had $200,000 worth of stuff. The assumption is that when we acquire this business, that we will be able to continue operating it and we will be able to continue getting that $200,000 a year cash flow. However, our ability to carry this on is going to depend upon whether or not the goodwill of the business will actually transfer to us as buyers. And so this is where we have to understand the concept of where the goodwill resides. Now, with our clients here at ALP, what we have is a tool that was called the Locus of Goodwill Calculator that I developed a couple of years ago. And it basically asks a series of questions about the business and how it operates. And the locus of goodwill calculator attributes points to one of three different buckets. And the whole idea is to try to get a visualization of where the goodwill in the business actually sits. And there's three different categories it can fall into. There's the owner, the location, or the business and brand. So, for example, if the owner of the business is the only salesperson and the owner of the business has a relationship with all of the customers, then this would be kind of a potentially dangerous sort of scenario for a buyer because the sales and continued earnings of this business could be related to the continued purchases of those customers. And if the seller of the business is the reason why they're choosing that business and the seller goes away when you buy it, then you may not be able to continue getting those sales, right? So in a scenario like this, you could expect a seller to be asked, for example, "Hey, I want you to stick around for like a year and work with me so that I can develop a relationship. If I'm buying it, I can develop a relationship with those customers." So that they'll become comfortable with me and they'll want to carry on doing business with me after you've fully retired or whatever, Mr. Seller. And so that would be an example of goodwill residing in the owner. An example of goodwill residing in the brand would be like a big company like Coca-Cola, right? Like, who knows who all the shareholders of Coca-Cola are? There's thousands and thousands of them, right? Famously, Warren Buffett is one. I don't know how many people buy Coca-Cola products because they know Warren Buffett owns it. Uh, who knows, right? People are buying it because they have some kind of positive affiliation or feeling about that brand name built upon, 100 years of advertising, right? So that would be an example of the goodwill residing within the brand or the company. And this can also happen in the world of small business, right? You may not know who the owner of a business is that you use, for example, that could qualify as a small business. Could be a plumbing company, could be a company that, is operates a retail store that you go into. You don't necessarily know who owns it, but you go there because you've always gotten good service there, and the people who greet you are always friendly, and they may not be the same people all the time, right? And so that would be an example of a business where the goodwill is residing within the brand or the business. The third bucket I mentioned, location, some businesses profit tremendously because of where they happen to be situated. And so if you think about a corner store, if everybody in the neighborhood knows that there's a store at the corner where we can go get, milk and bread and chips and all that kind of stuff, and the store changes hands, it could even change its name. And as long as it's still there, a lot of people just keep going there because that's the corner that has the store, right? And so in a scenario like that, and I've seen this over the course of time with things like used furniture stores, gas stations would certainly qualify in this regard if you happen to be at the prime location at a major, highway interchange or something like that. Like there are many businesses out there that profit because of their locations. In this scenario, if you're a buyer, then the lease or the ability to control that real estate or to buy the real estate, these would become really important functions of your deal, for example. So that was kind of like a primer on goodwill. If you want to get more deeply into these topics and you're thinking about buying a business, I would definitely suggest that you head over to businessbuyeradvantage.com. Over there, you're going to learn about the online training program, which has just been revamped here in 2025. All kinds of stuff has been updated, and there continue to be new updates all the time. We've actually just released yet another AI tool into Business Buyer Advantage. This one's called the Outreach Assistant. Basically helps people with crafting the perfect outreach document and doing research to try to find out who to address it to. So we are constantly working on this based on feedback from our students. If you're already a student, just go over there and log in. Go to the login place you always do. All the stuff that's been updated is available to you. If you haven't enrolled, go over to businessbuyeradvantage.com. You can learn more about the program over there and sign yourself up. once you get in, you're in forever, and any new updates or any new content is available to you as well. And with that, I will say thank you very much, everybody, and we will see you later.
So, how can you learn more about buying, selling, financing, and managing small and medium sized businesses? Easy. Go over to my blog site, davidcbarnett.com, where you can learn more about me and how I work with my clients. You can learn more about my books and courses that I prepared for you. You can find out how to subscribe to my email list, the YouTube playlists, and more. There's literally hundreds of hours of content there, all for free, and I'd love for you to be my guest. Special thanks go to Mark Willis at Lake Growth Financial, today's video sponsor. Mark helps people better manage their personal and business finances through the Bank on Yourself insurance strategy. This is something I've done personally and I've seen others use it successfully for years. Go to newbankingsolution.com to find all the interviews I've done with Mark and learn more about the advantages of these programs. While there, sign up for a free consultation to learn what this solution might look like for you.